Welcome back to the Deep Dive. We take the complex reports, the insider notes, and the crucial research that you've shared with us, and we distill them into the sharpest, most actionable insights you need to know.
Today, we are really cutting through the noise. We're diving deep into the core question of modern finance. How exactly is artificial intelligence being integrated into investment management right now?
Right, and this isn't about, Silicon Valley vaporware or some kind of futuristic speculation. This is about the competitive reality of 2024.
It's about the hard data on what the industry is actually doing.
Absolutely.
Right.
And our entire deep dive today is based on what I would call a major reality check. It's the Mercer 2024 Global Manager Survey. They polled 150 asset management managers globally. And I have to start with a statistic that completely changed how I view this landscape.
Okay, let's have it. What's the starting point that just recenters the whole conversation?
Well, it's this number that frankly refutes the whole idea that AI in finance is some, nascent experiment you can afford to ignore. 9 out of 10 managers. That's a staggering 91%. They're either already using AI or they are actively planning to integrate it within their investment strategies or their asset class research in the immediate future.
Wow. 91%. That fundamentally shifts the conversation from should we adopt AI to
Sure, how far behind am I?
exactly. How far along is everyone else? If you hear people talking about AI adoption as if it's still optional or niche, that number is the reality check.
It really is. And to break down that 91% a little bit,
Yeah.
54% are confirmed current users,
More than half the industry.
and another 37% are actively planning the integration as we speak.
That data point, more than any other, it just defines the new competitive environment. I mean, if you're a portfolio manager, an analyst, or you're running an investment firm and you are in that tiny, what is it, 9%?
9% who have no plan.
If you're in that 9%, you are now firmly in the historical minority. AI integration, it's no longer the competitive ceiling, it's the competitive floor.
It's just table stakes.
It is. It's just what's required to participate in the modern financial ecosystem. I mean, the firms that delay, they risk falling hopelessly behind in efficiency and, frankly, in data synthesis.
And that sets our mission for this deep dive perfectly. We're using this survey not just to chart the adoption rate, but to provide a really concrete reality check on the true scope of AI adoption. And crucially, we need to differentiate the two primary ways managers are deploying this right now.
Yes, that distinction is vital because the term AI just gets thrown around so loosely, especially in the media. We have to be clear about the difference between, say, generative AI, Gen AI, and the more established predictive AI applications.
Okay, so let's lay that groundwork. How are managers thinking about these two categories and what's each one good for?
Well, predictive AI is all about identifying complex, nonlinear patterns in huge data sets to forecast outcomes.
So like highly advanced statistical modeling.
Exactly. Pattern recognition. It tells you what is likely to happen based on past correlations. It's really optimized for systematic decision-making. I mean, this capability has been the engine room of quant finance for 2 decades now. It's the scientist in the lab modeling the universe.
Right, whereas generative AI, that's the technology that's been grabbing all the headlines recently, the large language models and their cousins.
Precisely. Gen AI primarily augments existing human cognitive processes. It excels at summarizing, structuring, and generating new content based on massive stores of unstructured data.
So you could feed it thousands of earnings call, transcripts, legal filings, news articles.
And it can instantly synthesize those into a coherent, structured report, or it could generate entirely new drafts of analyst notes. It doesn't necessarily predict the market. It tells you how to write the analyst note based on existing language patterns, or it helps you discover an idea you hadn't even considered because you missed a nuance in some filing.
So it's like an incredibly smart, tireless research assistant.
That's the perfect analogy.
So we're looking at advanced modeling for systematic forecasting. That's predictive. Versus advanced augmentation for human cognitive efficiency. That's generative. Maybe we should quickly establish the core capabilities that managers themselves agree on when they say AI.
Yes, the foundational stack. They're talking about the headline-grabbing generative AI, Gen AI, and large language models, LLMs. These are often intertwined with natural language processing, NLP, which is the tech that lets computers, understand and interpret human language.
And then the big one that's been around for a while.
Right. Underpinning much of the established predictive work is machine learning ML models. So those 4 capabilities, Gen AI, LLMs, NLP, and ML, that's the technological foundation that 91% of the industry is focused on.
Okay, so now that we've established that the adoption is just Overwhelming. The next step has to be understanding the quality and the hierarchy of that adoption. Is the investment world being run by autonomous systems, or is this still very much a human-led process?
The data gives us a very clear and, well, perhaps a reassuring picture for the human analysts out there. We need to dive into the specific adoption breakdown because it reveals a fascinating and really telling hierarchy of how this tech is being deployed.
We know 54% are current users of some form of AI.
Yeah.
But when you look at the specific tools, the hierarchy seems to tell a story about trusting the proven tools over the revolutionary new ones.
That is the key finding here. While Gen AI dominates the media cycle and, the public imagination, it lags pretty significantly in current deployment within core investment strategies.
How about
Well, the survey shows that established machine learning models are currently in use by nearly half of managers, 48%, and then LLMs and NLP follow closely behind that, used by 44%.
in Gen AI, the one that supposedly changed everything with ChatGPT?
That's currently being used by only 26% of managers.
26%.
And this disparity is crucial. It means that for generating immediate alpha, enhancing risk management, and refining the workflows they already have, managers are relying on tested, established quantitative tools. ML for complex pattern recognition, NLP and LLMs for sophisticated data sifting. These are tools where the results are. Well, they're more transparent, more auditable, and they have a track record of stability.
But the industry clearly sees which way the wind is blowing. Because when you look to the future, that hierarchy just flips completely, doesn't it? It confirms that managers see Gen AI as the next big wave.
Exactly. When managers were asked about their plans for future integration, Gen AI leads the charge. Just over half, 51%, intend to deploy Gen AI capabilities in the future. And that far surpasses the planned adoption for LLMs, NLP, and certainly for ML.
Which suggests a really strategic, almost two-speed approach.
It is. Today's efficiency gains and predictive alpha are being generated using mature ML and NLP models that have been iteratively refined over years. But the industry recognizes that the next wave of productivity, the acceleration of idea generation, the rapid summarization of market knowledge, that's going to come from Gen AI. So they're spending now and planning for that augmentation, even if full deployment is still in progress.
And this leads us directly to what you were saying earlier. AI is fundamentally being adopted as a co-pilot, not a replacement. The data seems to really show the limits of automation.
It really does, and those limits are dictated by the industry's need for oversight.
I mean, when you look at the degree of automation that's actually reported, it's remarkably low across the board. We're not talking about fleets of autonomous investment vehicles making trading decisions without supervision here.
Not at all. Despite the high adoption rates, only a tiny minority report fully automated processes. For statistical models, only 11% are fully automated.
Just 11%.
For machine learning, it creeps up a little bit to 14%. And for the most advanced deep learning models, it drops to a mere 6%.
6%. I find that fascinating. Yeah. That confirms that even with the most advanced deep learning, the vast majority of AI processes rely on constant human intervention. Why is that human layer so persistent and essential, especially in finance?
It all ties back to risk management, accountability, and fiduciary duty. I mean, think about it. If a model loses its efficacy, or if it encounters a market regime change, or triggers some kind of unexpected black swan event, the manager needs to be able to understand why that decision was made. They need to be able to pause the process and intervene.
So an 86% human oversight rate on ML models isn't a sign of failure, it's a feature.
It's a feature. It demonstrates that managers are currently unwilling or, frankly, legally unable to relinquish control entirely. Managerial judgment and accountability are still viewed as the ultimate value add in front of the client.
And this reliance on the human element, it's clearest in how the AI analysis feeds into the final high-stakes investment decisions, right? What are the actual roles AI is playing in that pipeline?
We can break it down into three major categories of integration. The most common role, which is reported by the majority of these teams, 56%, is that AI analysis informs the decision. It doesn't determine it.
So it provides better inputs, new data, faster synthesis. But the final call is still with the human portfolio manager.
Exactly. It's a powerful advisory layer. Then you have the next tier of integration, where the AI is a bit more proactive.
Oh.
Right. A fifth of teams, so 20%, report that their AI proposes specific decisions, and the investment team can then explicitly override that proposal. This is the classic co-pilot scenario.
So it suggests a trade, an allocation change, And the human manager still has to hit accept or reject.
Or modify. It strikes a really nice balance between efficiency and that crucial oversight.
And the fully automated hands-off zone, that 10% we mentioned earlier.
That's confined to just 10% of teams. And let's be clear, that 10% is heavily, heavily correlated with the systematic or the quantitative managers. They've been running models that execute decisions based on periodic human evaluation for decades. For them, AI is just an improved, faster, more complex version of what they were already doing.
So for the vast majority, the other 80%, AI is a tool to make better informed decisions, not to automate the decision itself.
Precisely. The expert judgment remains crucial in interpreting the insights and considering all the qualitative, non-quantifiable factors that an AI might miss.
The analogy really holds up. AI is supporting the pilot, giving them superior navigation and risk assessment tools, but the pilot is still flying the plane. They're still responsible for the flight path. The sensationalism is really tempered by the legal and practical need for human oversight.
Well said.
So, since we've established AI is currently the co-pilot, the obvious next question is, where is it actually moving the needle?
Right.
Where is that co-pilot providing the most measurable alpha? And how are managers using these capabilities right now to get an edge?
The survey data is really clear on this. The immediate tangible value is an augmentation. It's about making the human manager faster and smarter by fundamentally expanding the universe of usable data.
So the primary utility is really about expanding data sets, better analysis, idea generation.
And identifying those hard-to-find proxy signals, that's a big one. It's like the big data driver is really leading the charge, solving that problem of just information overload.
How big of a driver is it?
Well, 40% of managers cite the use of AI specifically for big data analysis. And this isn't trivial. This means they're incorporating alternative data sets, everything from supply chain flow data and ESG metrics to credit card transactions and anonymized mobile location data.
Stuff that was just too vast or unstructured for human teams to process before.
Exactly. They're running predictive, descriptive, and prescriptive analyses on inputs that were previously too fast-moving. This enhanced data gathering, access, and analysis is at the absolute forefront of their alpha pursuit.
Okay, so give us a flavor of what this looks like on the ground. What are some of the common use cases that are driving idea generation and research efficiency?
Well, beyond the obvious things like, searching vast regulatory archives or summarizing transcripts at incredible speed, nearly a third of managers, 32%, use AI to actively support idea generation.
How so?
This might involve refining an investment universe based on subtle correlations found in that alternative data, or identifying entirely new trade opportunities that traditional factor models just missed. The AI is scanning the horizon for things the human hasn't even thought to look for yet.
And that brings us to a really compelling, specific example that was cited in the survey, illustrating the power of natural language processing.
Yes, the example where one manager trained an NLT model to categorize the nuanced sentiment embedded in their own fundamental analyst's notes.
Wait, not news reports, but their own internal notes.
Yeah, their own notes. This is augmentation in its purest form. Think about that. It wasn't analyzing the market sentiment from Reuters. It was analyzing the subtle conviction levels, the specific language cues, the tonality of its own internal experts. And then it used that categorization as a predictive signal for future performance.
So the AI is capturing human intuition at scale and then feeding it back into the predictive model.
That's it. It's capturing tacit knowledge. And that ties into another crucial use case cited by 31% of managers. Filling in the blanks, especially in complex areas where data is sparse, like, say, quantifying sustainability factors.
Right, ESG data for a small cap or a private company can be really messy.
Or non-existent. So if direct, clean, auditable data on an ESG factor like water usage or social impact is unavailable, the AI can sift through public reports, news articles, legal filings, and it can triangulate and create a sophisticated proxy score or a predictive input.
Okay, so that's research and idea generation. But how many managers are deploying AI in the areas that are typically considered the core of a manager's value add, the really complex parts of portfolio management?
This is where the numbers drop a bit, but the impact is profound. It touches the very heart of the management function. 25% of managers report using AI for direct investment decision-making support.
A quarter of them.
21% are broadening the inputs to their investment risk management frameworks, which is a huge step toward identifying those unforeseen risks. And 18%, nearly a fifth, are using AI in the highly complex area of portfolio construction and rebalancing.
18% in portfolio construction that's incredibly significant. I mean, this step from using AI for operational efficiency to deploying it in core investment management, that feels like the true leap.
It is, and we have a great example of this sophisticated application cited in the source material. A manager using a random forest factor timing model to dynamically adjust investment strategies during rebalancing.
Okay, we should pause on that. For our listener, what exactly is a random forest factor timing model, and why is this so important?
Well, think of it this way. A random forest is a type of machine learning technique that builds an ensemble of many individual decision trees. So instead of relying on one single fragile model to predict an outcome, you're relying on hundreds or thousands of models working together.
So it's more robust, less likely to be wrong because of one weird input.
Exactly. It minimizes the risk of overfitting. And factor timing is the strategic adjustment of exposure to broad investment factors like value, growth, momentum, quality based on dynamic market conditions.
So instead of a human analyst saying, I think growth is going to outperform value next quarter, so let's shift exposure, the AI model is doing that.
It is. It's aggregating thousands of alternative and traditional inputs to recommend that exposure shift in real time or dynamically during the rebalancing window. It's identifying the optimal time to be heavily exposed to value stocks versus growth stocks. Deploying an AI framework like that, it means the portfolio becomes tactically responsive to complex market regimes.
It's also worth noting the split in how they're applying this. The bias seems to be clearly toward bottom-up security selection.
That's correct. 53% of managers use AI for individual security selection, which informs that classic bottom-up approach.
Analyzing a specific company.
Right, and that compares to a significantly lower 37% who use AI to inform or generate macro or top-down views.
So the data suggests AI is currently much better at picking a specific stock or bond than it is at predicting, say, global macroeconomic shifts or where interest rates are headed.
For now, yes. The complexities of macro data political risk, global supply chains, central bank signaling, it still requires a level of qualitative human interpretation that's much harder to automate. And again, only 14% view AI as a default or key part of their overall investment process, and that 14% is firmly the existing quant cohort.
Let's pivot back to generative AI for a moment. We saw that current usage is low, but the future intent is massive. Are managers genuinely optimistic that Gen AI will eventually deliver alpha, or is this just hype driving their future planning?
The optimism is overwhelming, and it's quantifiable. Among current AI users, nearly three-quarters, 72%, expect the integration of Gen AI to improve their investment decision-making processes.
72%.
And a full 19% expect that improvement to be significant. This high expectation is the engine driving that massive planned adoption rate we discussed earlier. They aren't just adopting it, they're betting on it to be transformative.
So where do they expect Gen AI to have the most significant impact on generating this alpha?
They identified four primary areas. First, and most important, is enhancing the monitoring of existing and potential investments. 52% see a significant or very significant impact here. This is crucial for managers facing that tsunami of real-time data.
So AI helps make sure they don't miss some emerging risk factor that would slip past a human.
Exactly. The second is the expanded idea generation we discussed, cited by 49%. Third is providing breadth of understanding of a sector or a vertical at 43%. Gen AI can rapidly synthesize complex sector reports, allowing a PM who specializes in one area to quickly get up to speed in another.
And the fourth area is where operational efficiency converts into actual alpha, the hidden source of return.
That's right. Generating operational alpha is highly anticipated by 46% of managers. This includes things like improving execution, driving down trading costs through smarter order routing, predictive liquidity modeling.
So not just better ideas, but a cheaper, faster way to execute them.
A cheaper, faster, and more robust way to execute them and monitor the consequences. And that boosts net returns.
Okay, let's shift our focus to the market landscape itself. Where are managers seeing the most immediate opportunity to create value? And why does that opportunity seem to differ so much by asset class?
The survey reveals a very strong logical correlation between the perceived opportunity and the investment's characteristics, specifically speed of execution and the liquidity of the underlying asset.
So the quicker the market moves and the easier it is to trade, the greater the immediate opportunity for AI to prove its worth.
Absolutely. This places the highly liquid, high-frequency markets right at the top. Equities lead significantly, with 61% of current users seeing very significant or significant prospects for value creation. AI's ability to process news, sentiment, and pricing data instantly makes it indispensable there. The feedback loop is immediate.
And hedge funds are right behind them.
At 53%, yes. reflecting their mandate for tactical, often shorter-term strategies. Digital assets, fitting that high-speed, high-liquidity profile, are next at 45%, and fixed income comes in strongly at 47%.
Fixed income is interesting because it seems like AI could help on both the micro and macro levels there.
It can. From a bottom-up perspective, it can substantially enhance credit analysis, automating the deep dive into corporate bond issuers. But from a top-down view, it's crucial for improving macro and geopolitical analysis, helping managers position bond portfolios correctly against interest rate and inflation risks.
And conversely, the illiquid markets, private equity, private debt, real estate, they see a lot less short-term value creation.
That's because the primary advantage AI offers, speed of data processing and execution, is fundamentally less impactful in markets where assets trade, once every 5 or 10 years. The value add there is driven by deep operational improvement and long-term due diligence, which are just harder to automate with current AI models.
And with hedge funds, there's a nuance here, right? Because a lot of them have been doing some version of this for a long, long time.
They have. The quantitative and systematic funds have a 20-year head start in machine learning and process automation. For them, current AI integration is often just an evolution, an incremental step function built on an existing infrastructure. They're adding LLMs to refine sentiment signals, but they aren't fundamentally shifting their approach.
But for the traditional fundamental managers within that hedge fund space, it's a different story.
It is. For those fundamental teams, AI implementation is intensely focused on efficiency and productivity gains. It's about compressing processes that used to take weeks into hours, rapidly summarizing legal documents, speeding up valuation modeling, processing earnings transcripts instantly.
So it's allowing the fundamental managers to compete with the quants on the velocity and scale of information processing.
Without fundamentally changing their investment philosophy. That's the key.
Okay, shifting to sectors. The perceived opportunity differs a lot by industry. Where is AI expected to create the most value for firms who are investing in those sectors?
The concentration is heavily skewed towards high data, high innovation industries. Unsurprisingly, the technology sector is the most prominent opportunity, cited as significant by 83% of managers.
It's an obvious feedback loop. AI will create alpha by investing in the most successful AI innovators.
Right. And following that, you see sectors defined by complex data and rapid change. Healthcare at 72%, financial services and wealth management at 70%, legal services at 66%, and banking at 64%. The alpha here is generated not just by using AI internally, but by using it to master and find value within these complex, data-rich industries.
Which brings us back to the private market and venture capital. Their use of AI seems to be lagging the public markets. Why the delay in a sector that's defined by innovation?
The delay is structural. Traditional valuation models are just harder to automate in private markets. You have a fundamental lack of frequent market marks, complex contracts, and a reliance on projected performance.
And what about the AI used by the VC firm versus the AI used in their portfolio companies?
That's a vital distinction. VC managers are focused on innovation, but they're wary of companies that just claim to be AI companies when they're really just deploying sophisticated software. The true AI applications they're interested in are deep within their portfolio companies, using Gen AI for visual diagnosis in healthcare, complex analysis in biotech, legal automation.
So they're looking for sector disruption, not just tool sales.
Precisely. And as for the VC manager's own use of AI for sourcing new deals, it's often based on LLMs, but it's not complex generative AI. It's more about massive screen scraping of platforms like LinkedIn or Crunchbase to aggregate data points on talent and past successes. It helps filter thousands of candidates down to a manageable few.
So it's machine learning for workload management, not Gen AI for analyzing the business model itself.
It's still very early days for that.
Okay, this takes us to the future. Macro expectations, but also the critical risks and structural barriers that managers are grappling with right now. And starting with the macro outlook, managers are incredibly bullish.
They really are. Managers currently using AI expect it to deliver substantial positive economic benefits. On average, they expect a colossal U.S. $14 trillion boost to the global economy by 2030.
14 trillion.
A figure that's right in line with other notable forecasts. And they also anticipate a 9% increase in global GDP over that same period. So they see AI not just as a tool for their own success, but as a fundamental driver of global economic expansion.
That level of optimism is stunning.
Yeah.
But it leads to what I think is the most fascinating contradiction in the whole survey, the market efficiency paradox.
Yeah.
60% of managers expect AI to increase market efficiency.
Right. Better information, faster prices, classic theory.
But simultaneously, a very large minority, 44%, expect AI to increase market concentration. How does that work?
Yeah.
How can it increase efficiency while also leading to a concentration effect, which is usually a result of herding?
It seems counterintuitive, but the reality they anticipate is driven by the speed of arbitrage. If 9 out of 10 managers are running similar advanced ML models on the same expanded datasets,
Even if they're customized internally.
they're likely to converge on the same conclusions, just at breakneck speed.
So AI just enables a faster consensus. If one manager finds a signal, the other 90% find it moments later, and they all pile into the same trade.
Exactly. And that velocity of consensus accelerates momentum trading, it creates synchronized market moves, and it increases the risk of concentration in a few dominant positions.
Hmm.
The risk is that AI just amplifies model convergence and creates rapid, self-fulfilling prophecies.
And on top of that, 56% expect AI to contribute to disinflationary forces.
This is a critical structural expectation. Managers believe AI drives huge productivity gains, enables automation, and intensifies competition, all of which should structurally lower costs and prices across the economy. It could be one of the most significant disinflationary factors of the next decade.
But of course, the path to that future is full of roadblocks. What are the barriers that are stopping managers from unlocking AI's full potential today?
The number one barrier is purely practical, and it directly reflects that current focus on data. It's data quality and availability.
The classic problem.
Always. It was cited by two-thirds of managers, 68%. If the core value of AI is ingesting and analyzing vast new data sets, then poor, inconsistent, or inaccessible data immediately throttles its effectiveness. If the underlying data is flawed, the sophisticated model you build on it is basically worthless.
And the other implementation hurdles are just as telling.
Integration and compatibility issues were cited by 54% of managers just getting the new AI tools to talk to their legacy trading and compliance systems. And 51% are concerned about ethical and legal considerations, which is a massive hurdle. Data governance, privacy, compliance.
We also can't ignore the high concerns around security and privacy risks at 47%, and the lack of explainability and transparency also at 47%.
The black box problem is existential in finance. If an AI model makes a disastrous trade and you can't explain the logic that led to that decision, especially to regulators or clients, it becomes impossible to satisfy your fiduciary duties. This lack of explainability is what really limits automation and reinforces that co-pilot role.
And the macro risk that sort of transcends all of this is regulatory divergence. This is seen as a significant risk by nearly half of current users, and it rises to 57% for managers who are still just in the planning stages.
That concern about fragmented regulation is huge for global asset managers. They face uncertainty about what models they can legally deploy in different jurisdictions. The US, the EU, Asia are all moving at a different pace. If the rules diverge significantly, it makes building a single, scalable, global AI strategy virtually impossible.
And finally, we have to reinforce the caution we're seeing in product development. It stands in stark contrast to the high adoption rates.
It does. It's a crucial finding that tempers the hype. 64% of current AI users have not launched formalized AI-related investment strategies, and they don't plan to in the next 12 months.
So they're using it to augment their existing strategies, but not to build new ones from scratch.
Exactly. The latter is just a much higher risk proposition with huge uncertainty around long-term performance and what regulators will even allow.
Okay, let's look at the nuts and bolts, the operational reality, and how firms are actually structuring their investment to support all this. And this part of the survey really challenges the media narrative that this is some sudden recent phenomenon.
It certainly does. I mean, we've had a massive surge of interest since late 2022, but the survey shows that for many, AI integration is a measured, multi-year evolution. Yes, 21% integrated in the past year, but more than a third, 36%, began their journey over 3 years ago. Some of the leading quants started over 15 years ago.
And that long evolution probably explains why the investment focus is so heavily weighted toward those core capabilities we defined earlier.
It does. Over the past 3 years, managers have focused investment primarily on ML, 70%, NLP, 64%, and lagging slightly, Gen AI, 57%. They aren't abandoning the established tools, they're building upon them.
So let's talk about the money. Despite all this adoption and investment, nearly half of managers, 47%, don't even have a dedicated annual budget specifically for AI resources.
That statistic is so telling. It suggests the spending is being absorbed into general tech or project budgets. It hasn't yet been elevated to a distinct high visibility cost center for many firms. It's still viewed as part of routine digital transformation, not some unique high priority project.
And among those who do have a specific budget, the allocation is relatively small. That surprises me, given the $14 trillion expectation.
Well, the majority, 30%, allocate between just 0.1% and 2.9% of their total firm revenue. This reinforces the idea that for most firms, current AI spending is aimed at incremental efficiency pilots, integration, augmentation. It's not yet the massive multi-billion-dollar build-outs we see in the leading tech firms.
And how are they getting the models? Building, buying, or open source?
The preference is heavily skewed toward proprietary or controlled solutions. They want to maintain a competitive advantage. More than half, 55%, are using closed-source models, and a marginally lower proportion, 52%, report using internally developed models, though this probably includes firms who are just fine-tuning open-source models internally.
So they want to control the secret sauce. The perceived alpha comes from unique data and proprietary models.
Okay.
Let's transition to the most important element: people and commercial outcomes. Managers overwhelmingly anticipate AI's benefit to play out through enhanced productivity.
That is the consensus goal. 93% expect the benefits to come from enhanced productivity over the next 5 years.
So productivity gain is the focus. But what's the impact on headcount? Are we going to see mass layoffs across the industry?
On a 5-year view, the answer is surprisingly conservative. More than half of managers, 55% of current users, do not expect AI to affect overall headcount across their organization.
So AI doesn't replace the analysts, it just makes the analysts they have drastically more efficient. But that efficiency must require a different type of employee.
Absolutely. The composition of the workforce will change fundamentally. 72% of current users believe AI will increase the need to recruit staff with new skill sets, and 64% expect it will affect their ability to find and retain the right talent. The focus shifts from manual labor roles to highly skilled engineering, data science, and governance roles.
And finally, we get to this commercial outcome ambiguity. If AI is driving all this efficiency, why isn't every manager expecting huge increases in AUM and revenue?
This is the realistic interpretation of the data, and it's the key insight for competitive positioning. Expectations around AUM and revenue are really mixed. About 46% expect increases, while 49% to 52% expect things to stay constant.
Which implies a significant truth. AI may not be a guaranteed revenue booster for any single firm.
Instead, it's a necessary investment to deliver superior efficiency. If your AI integration doesn't deliver productivity gains and lower unit labor costs, your firm will experience margin contraction relative to your competitors who are realizing those efficiencies.
So end investors may not pay more for an AI-driven strategy, they just expect the existing fee structure to deliver those efficiencies.
Exactly. AI is quickly becoming a required defensive investment just to maintain competitive margins and remain relevant. It's not an automatic source of new high-margin revenue.
This brings us to the conclusion of our deep dive. So what should our listener, the learner, take away from this comprehensive survey?
I think the core findings synthesize into a powerful 4-point reality check. First, AI integration is mainstream. 9 out of 10 managers are involved. It's not just the quants anymore. Second, its function right now is augmentation. It's a human co-pilot, but managerial judgment is still the final arbiter.
Third, the immediate value is being driven in liquid, data-rich asset classes, like equities and hedge funds, because the competitive edge there correlates so strongly with speed.
And fourth, the major roadblocks aren't really the technology itself. It's the foundational elements. Poor data quality and the huge challenge of divergent global regulation.
And the report itself offers some excellent strategic takeaways for managers. Adopt a strategic approach focused on business goals, not just tech for its own sake. Put data privacy and security at the core.
And be realistic about the financial implications. Be cost-aware of model training and sourcing costs. And crucially, think long-term about your people strategy. The need for staff with new, highly specialized skill sets is immediate, and managing that talent is critical.
That structural reality, that AI is a defensive necessity and the resulting market concentration paradox, that sets the stage perfectly for our final thought. The source commentary gave us a crucial line, noting that alpha is a zero-sum game and everyone is spending.
So the question for every investment manager and every serious investor listening to this deep dive is this. If 9 out of 10 managers are already using AI to expand data sets and generate ideas, meaning the competitive advantage from these basic capabilities will be arbitraged away almost instantly. What will the next truly transformative step function in investment management look like? And who is currently investing in that secret high-risk capability?
That is the multi-trillion-dollar question for the future of finance. Thank you for diving deep with us. We'll see you next time.